Welcome back to the Inner Game podcast, where we explore the depths of money, investing, philosophy, and life. I'm your host, Vishal Khandelwal, and today we get into the world of stock market returns. And I am going to break down two crucial sources of those returns that every investor needs to understand. Now, whether you are a seasoned investor or just getting started, I think this insight shall be invaluable for your investment journey ahead. So you see, there are two sources of stock market return, and they play a very critical role in shaping the outcome of your investments. First, we have what's called the investment return. And this is the part of your return that depends on the underlying business you own. And it is all about the fundamentals. And so you want to pay close attention to factors like a business's growth in revenue and profits, its profitability, return on capital, and the strength of its balance sheet and cash flows. When a company is growing steadily, it's generating healthy profits and cash flows, it's efficiently using its capital and maintaining a strong balance sheet, it's more likely to provide you with a solid investment return over a long period of time. And these are the kind of businesses that can stand the test of time and create long term wealth for shareholders. The second source of stock market return is what is known as speculative return. And this one is a bit trickier because speculative return depends on the speculative tendencies of all the other people participating in the market. It's all about what other people think and how they behave in the stock market, and especially in the short run. And like Ben Graham said, in the short run, the market is a voting machine where people vote through emotions. But in the long run, it's a weighing machine where the weight of businesses are captured and investors do as well or as badly as the underlying businesses do. And this is where things can get a bit dicey. When we base our expectations on speculative return, we are essentially gambling on the opinions of others. The market can be influenced by emotions, it can be influenced by rumors, market sentiment, and all of this can lead to unpredictable price swings in the short run. And this is where many investors get into trouble. They start chasing hot stocks, they start chasing IPOs or following the crowd without really understanding the businesses they are investing in. It's like trying to predict the weather by listening to the opinions of random people on the street, which is not a good idea, right? So the question is, what's the way to go? Well, if you understand a bit of where I come from, it's pretty clear. Just focus on what the business is doing and forget what others are doing. In fact, when you do that, that is focus on businesses instead of focusing on what the stock prices are doing, it is the best thing you can do as an investor. And if you really wish to pick stocks, dig into the financials of companies, understand their competitive advantages, keep an eye on their long term prospects, and also know what can go wrong for them. When you base your return expectations on these factors, you are on a good and peaceful path to success as an investor. At the end, please remember that the stock market can be a wild ride, but it does not have to be a roller coaster of emotions and uncertainty. By focusing on what the business is doing and basing your return expectations on that and only that, you can become more informed and confident as an investor. That's a wrap for today's video. I hope you found this breakdown of investment return and speculative return helpful in your journey towards investment success. If you did, please share with others and subscribe to my channel for more valuable insights on investing and more. Thank you for joining me today. Remember, it's your money and your decisions should be based on sound research and analysis. Stay smart, stay informed, and I'll see you in the next video. Until then, happy investing and happy living.